Ladies and gentlemen, boys and girls, you're watching a Wednesday, January 26th episode of the Engine Room podcast, brought to you by tokenmetrics.com. If you're confused and overwhelmed by crypto, you're not alone. Token Metrics is a resource that's available to help you tactfully walk the line between genius and degen. On today's episode of the podcast, we are joined by Mr. Jacob Koch-Gallup. What's up, Jacob?
Hey, Dylan.
Stephen Tuttle, our writing wizard.
Hello, everybody.
And we got to give a special thank you and shout out to our external guest, Mr. Philip Blows. Philip is the CEO and co-founder of a company called AQRU. He's also the author of a book called The Money Triangle, 3 Simple Steps to Transform Your Finances and Achieve Financial Freedom. We're looking forward to talking to him and learning a lot more about him and his company. But right off the bat, guys, we got to jump into some news because for a pleasant change, it's not all doom and gloom today. We actually have some interesting things to talk about in the crypto news cycle. Let's start with this news that Libra is selling off its assets and basically pleading, we're dead, we're dead. If anybody's unfamiliar with what this is, Libra was basically Facebook's cryptocurrency play. And now it seems that they're finally saying, hey, we bit off more than we could chew, and we weren't cut out for it. With Libra selling off its assets, it's kind of a positive sign for decentralization at large. Facebook is, of course, a large centralized company. They tried to make this happen by appeasing regulators first and then trying to build something, and it just didn't work. Do we have any hot takes on what this might mean? I think it's just a good sign for decentralized currency in general. Build it first and they will come, whereas Facebook was like, no, let's make the big regulators happy first and then they will come. What do we think about this, guys?
Yeah, I completely agree. I think this shows how centralized crypto blockchain is just not going to work. At least maybe that's just a hope of mine. I also kind of see it similar to central banks. Cryptocurrencies, the whole point of cryptocurrencies are to be decentralized, to get away from banks. So when big major centralized corporations and big national banks of countries create their own crypto, their centralized blockchain, it's just, I don't think it's going to work. I don't think it's going to get the same support that these decentralized networks and blockchains get.
Yeah, Facebook tried to make a stablecoin, and that is a stablecoin from a corporation. In this coming year, in the rest of 2022, I actually expect to see CBDCs, which are stablecoins from a government. But in terms of coming from a corporation, I think it is exactly like what Jacob and what you were saying, Dylan, that it's way more difficult to make a centralized stablecoin.
Yeah, if I were going to put it through what I think happened, they simply had too many resources and too many ways to fail. Too many moving parts in their machine, and it ended up kind of blowing up in their face. Anyway, moving right along. I'm happy that the way is clear for smaller, more motivated companies to bring this stuff to life. Let's talk about NFTs because there are two interesting NFT news items here. First of all, the Picasso family is entering the NFT game. Pablo Picasso's granddaughter Marina and her son Florian have uncovered, of course, they have all kinds of Picasso artwork that's never been seen in their apartment in Geneva these days. But they are putting up for auction a piece of ceramic work by Picasso. And immediately connected with this is, what's the number? 10,100, Jacob?
10,010 NFTs. So yeah, they're
10,010 NFTs associated with this ceramic bowl. It's all going to be auctioned by Sotheby's in March. What do we think? I kind of take a snarky tone on this, guys. I think the Picasso family sees a new way to cash in on art, even if their name carries quite a bit of street cred. I don't know what they're doing here that's especially new or interesting, other than, hey, now we have this big and established name entering the NFT space through his descendants.
Yeah, I think it's kind of half and half. I think it's half kind of a money grab, half. I mean, but at the same time, how much money does the Picasso family really need? Probably not a lot. But I was also reading that it's kind of their way of trying to connect this old art form with new NFT art forms. And they said, well, Picasso would love it because he was an innovator. I do think it's a little weird that they're first selling 10,010 NFTs of this ceramic bowl that aren't related to the physical piece at all. And then they're selling the physical piece later at the Sotheby's auction with a separate NFT link to it. They are, each of the 10,010 NFTs that they're auctioning that they're selling very soon has a music piece built in with it by the granddaughter who's a DJ, also John Legend, the singer, and Nas, the rapper. So there is a music component too. I don't know how they're gonna, maybe is this, I'm thinking maybe the NFT is just like an animation or something of the bull, or is it just going to be like a picture, an iPhone picture of the bull? That's kind of weird. I don't know how exactly that's going to work.
Perhaps predictably, the Picasso family is keeping this a little close to the chest. We don't know all the details here, and I think they're kind of happy to have something to wave in front of us and get our attention. But of course, we don't know any substantive details yet. The Sotheby's auction is in March. I'm sure we'll learn a bunch between now and then.
I thought it was fascinating because this isn't the first time sort of an artist has really done this. And what Damien Hirst did, I'm not sure if you remember that, but he...
remind us, please.
So yeah, Damien Hirst sort of did a specific art piece that he then created a load of NFTs for. And they were kind of prints of the original art piece. And what was really interesting is you either took ownership of the NFT or ownership of the underlying print. So if you took the NFT, they would destroy the underlying print. So it'd be really interesting if like the NFT holders of this sort of vase got together and elected to have the original destroyed and have it as a purely digital piece of art content. Would be quite amusing.
Yeah, it could happen. I could see that happening. Let's pivot again to another piece of NFT news, because Larva Labs, the company behind the notorious CryptoPunks, they're coming out on Twitter today saying that V1 of the CryptoPunks, they're calling this not the real CryptoPunks. And that strikes me as a rather precious distinction.
Blasphemy.
I kind maybe blasphemous, maybe a little self-important, but at any rate, it seems to mean something. And our guy Jacob pays quite a bit of attention to the NFT market, so I kind of want to throw it to Jacob for this. Jacob, what's going on with this story? Why is Larva Labs kind of impugning version 1 of CryptoPunks?
Yeah, well, first I think I need to explain what version 1 of CryptoPunks are. So they released 10,000 of the CryptoPunks that we know in June 2017. I think they were free to mint. There wasn't a lot of kind of fanfare about it. People weren't really buying into it. And then there was, there was about 400 people who finally minted all 10,000. And then a week or two later, they realized that there was a bug in the code of the smart contract that when you sold the CryptoPunk, the buyer was able to get their Ethereum back. So people could just buy the CryptoPunks for free. So then about 3 days later, they reminted all of them. They fixed the bug in the code. And then that's how we have our V2 CryptoPunks, which are now the CryptoPunks that everyone knows and loves. Just recently, people created a NFT wrapper, which allows the original V1 ERC20 CryptoPunks to be wrapped into ERC 721 tokens, which this gets rid of the bug and now just kind of reincorporates the original CryptoPunks. And it's actually the same. It's the same on the blockchain. It is the actual V1 CryptoPunks. They're not duplicates. So that kind of brings in a question. Well, Larva Labs is now saying they're not the official ones, but you can look at the blockchain. They are the actual official ones. They were just wrapped, and it's the same code and everything. So then it's like, okay, well, are these more precious because they're the OG CryptoPunks? There's a lot less of them. Larva Labs saying they have 1,000 of them, so they're kind of making the supply more scarce. Let me throw it back to you guys. What you guys think about this whole thing?
I must say I'm a bit confused. I might be speaking for not just myself here. So you're saying that there was 10K CryptoPunks made initially that had a bug in them, and then they got reminted, and now some people who had that,
and the bug was the bug affected the price. People could get it for free or less than full price. People could buy
the original and CryptoPunk and then receive their Ethereum back. so they could just buy it for free. They could pretty much just say, hey, I want that one, I want that one, and just take it.
They seem like real crypto punks
version
to me.
2 fixed this.
Yeah, version 2 fixed this, and version 1 went away because this bug was still existing. So no one really, like, everyone stopped trading version 1 CryptoPunks because the bug was still there. And just recently, someone created an NFT wrapper which changed the token, changed the actual code of these version 1s to allow them to be sold without this bug occurring.
It seems a little bit revisionist to me, because I think version 1 CryptoPunks are real CryptoPunks. They just had a slight technical bug. I'd love to see Larva Labs have the emotional intelligence to publicly say something like, hey, if you own these, you own a piece of history. Maybe it shouldn't be worth whatever it was actually worth, but we made this. The retroactive attempt to distance themselves from a bug, I think, is a little silly.
Yeah, I mean, right now I'm seeing these as kind of artifact NFTs. They're yeah, it's like a piece of history. It's an artifact. Yes, they may not be the real CryptoPunks, but they were the first CryptoPunks that had bugs in it. So maybe they're cooler. Maybe they should be worth more because there's less of them. Right now, there's trading around 6 to 7 Ethereum, which is a lot less than the V2 CryptoPunks. But I also think that Larva Labs is kind of shooting themselves in the foot by distancing themselves, saying, oh, they're not official, because everyone's like, yeah, they are, and everyone knows it because you can look at the blockchain and see that they're real. If they had came out and said these are real, these were a buggy version and they got fixed, then that would probably increase the price of the V1s and just look better. It's probably a smarter play on Larva Labs' part.
Well, let's pivot from there to another kind of technical story here. Let's talk about the end of Ethereum 2.0 and see what we can do to sort signal from noise here. Here's what I understand. There's always been a plan from day one to have something called Ethereum 2.0. But as of this week, that thing called Ethereum 2.0 is actually going to be a different thing. So Ethereum 1 is all about an execution layer, and Ethereum 2 is all about a consensus layer. And now the roadmap going forward is that those two things working together, this execution layer and consensus layer, that together will be called Ethereum. So all this talk of Ethereum 2.0, it has just seemed so cursed for so long because there have been delay after delay after delay. So really the news today is they're kind of saying, hey, this probably isn't going to happen. Instead, we're going to retrofit this thing so that it works the way it should, but the structure is going to be completely different. Have I sliced that correctly? Does anybody have any further take on
that? Phil, what do you have to say about this? You haven't talked in a while.
Yeah, I mean, I think it's an interesting one because, for the people who sort of care, they kind of understand a lot of the distinctions. So the idea of kind of glossing over some of its fairly unusual and history. I mean, I saw some of the commentary that came out about it, and it was just deliver it and stop talking about it and renaming it and these sorts of things. So I think this is probably just further frustrating the community as opposed to doing anything to sort of actually improve the image of the whole merging process.
Yeah.
So I think it's further pain for the Ethereum community, if anything.
I think I speak for a lot of crypto analysts where last year in 2021, I was a bit of an Ethereum maxi. I thought a lot of value would end up falling back down onto Ethereum. And I honestly thought that the 2.0 upgrade would happen way quicker and be more effective than it currently is. And I thought eventually Ethereum would become the main execution layer of the internet itself. But then I turned bearish once Vitalik went on the Bankless episode and said that Ethereum is currently only 50% done on its way to a 2.0 upgrade. And even before that, Vitalik came out with an article called Endgame, where he basically said that Ethereum does not want to handle as many transactions as it's doing right now, and it wants to offload a lot of those transactions onto layer 2. So I've become bearish because Vitalik, as well as the Ethereum Foundation, is semi-admitting that they don't have a handle on gas fees and that those gas fees are not going to be handled anytime soon.
I mean, hopefully that. Sorry. I mean, hopefully that just does push things, accelerate the adoption of these layer twos and other scaling solutions. Because yeah, from someone who runs an exchange, the transaction costs are just they are incredibly painful, and the only reason we have to execute and transact so much on Ethereum is because adoption of a lot of these layer twos like Phantom, which is one we're encouraging users to try and use with us as much as possible, just isn't widespread enough. So anything that kind of accelerates that process, if it's not going to come through transaction cost decreases on Ethereum, whatever we can do to try and find innovation in other pockets of the crypto market, it's going to be extremely valuable.
Yeah, so let's take it from bearish Ethereum news to bullish Bitcoin news. Kathy Wood of ARK Invest is in the news today because she has a new outlandish projection calling for $1 million BTC by the year 2030. A lot of her rationale behind this is just, hey, it's still early days for Bitcoin, and we're starting to see nation states adopt it, El Salvador, and there are probably some others to follow in those footsteps. But Kathy Wood analysis, in my opinion, is a little tainted these days because she is a notorious hype beast. I'm sorry to be kind of rude and reductive, but her entire thing is investing in disruptive, with a capital D, companies. And it has not played very well for her over the past year. If you look at the returns on ARK ETFs over the year 2021, that chart moves down and to the right. So I don't want to say anything like she doesn't know what she's talking about. She certainly got to where she is by being smart about money issues. But is she just trying to hype her own bags? What do we think of a legacy investor like Kathy Wood calling for 1 million BTC in the year 2030? By way of reminder, she called for $500,000 BTC in the year 2026. So she hasn't actually been wrong yet, technically. But how do we think about it when people of this stature, Elon Musk, Michael Saylor, they make outlandish price predictions? What does that actually mean?
I think it's great to see large institutional money managers taking such an interest in crypto. I mean, that's kind of the positive side, that this is, you would never call her an early adopter, but the skeptic would look at her top 10 holdings and see Coinbase sitting in there, which is going to have a loose correlation to Bitcoin price, I'm sure. So you could argue that there is a bit of talking your own book in there, but at the same time, anything that kind of raises the profile of crypto, and especially she has a good reputation. Obviously, the last year hasn't been kind to her, but she was the superstar fund manager for the years previous to that. Mm-hmm. So I think hopefully it does add a bit of credibility to at least traditional financial participants if someone of her stature is talking about it.
Right on. Well, thanks for that input, Phil. Let's definitely go ahead and shine a spotlight on Phil now that got the news out of the way here. Our guest today is Phil Blows. He's the co-founder and CEO of a crypto company called AQRU, which basically endeavors to help you earn more passive income through crypto. Phil, this is a complicated thing, in my opinion. I would love to know everything in the world about staking and generating yield. Could you talk a little bit about how AQRU solves this problem for dummies like me?
Yeah, I think this was I was in a very similar boat. I wasn't a particularly early adopter of crypto. And I was actually, sort of 12, 15 years in traditional finance. And I had this kind of experience where I was sort of advising customers on their normal financial habits. And this is where this book I wrote came from. But I spent 4 years where I actually ended up chatting individually to about 10,000 customers in the UK and asking them about their finances, saying, look, what do your spending habits look like? What are your investment habits? All these sorts of things. And it was a pretty depressing kind of analysis. Most people getting to the end of every month, nothing left to invest. If they were investing, it was all sitting in cash and not growing. And it was all pretty depressing. And then as I moved into kind of crypto, you could see that there was just these amazing opportunities to generate yield on assets, and there was a degree of risk that went with that. But having spoken to all these people, I'm a massive supporter of decentralized finance. I love it, but I know in its current state now, the majority of people are never going to be able to access it. It's just totally inaccessible. And for me, that almost doesn't seem fair, because I was looking at these people who are not in good financial situation and seeing a way that they can pretty consistently generate high yields well above what they're getting from their current investments. So just wanted to have a nice, easy way for them to be able to access, to be that kind of translation layer that sits on top of all these DeFi protocols. But the idea of not having to open a wallet and not having to pay gas and having to connect it to a DeFi protocol and then work out the complexities and the risk that goes with that. I was just by abstracting all of that away and putting it into a really simple to use app. That's the target market that we're after. Because I appreciate there's a lot of people out there who are able to go and do all this themselves and have a they're investing in every or they're connecting their wallets to every degen sort of yield farming opportunity that appears, right? They're going to do their thing. We're aiming for kind of the mid-market, sort of mass affluent, amateur investor who wants to generate yield. So really, in terms of how we do it, we've got a great analyst team. We've got a very limited number of investments that we have on the platform. So we're only really we're paying 12% on stablecoin, 7% on Bitcoin and Ethereum, and really sitting behind that is just a huge screening and analytical exercise that goes across the entire DeFi space, looking for the best opportunities, and then building a very diversified and widespread portfolio, which of course is very, very gas intensive, but it kind of spreads risk in a way that enables people to sort of, an individual would never be able to do it themselves because they just don't have the assets at their disposal, probably.
Gotcha. How would you compare or contrast AQRU to a company like Celsius?
Obviously, we're a lot friendlier. How would we compare to Celsius? I mean, Celsius have done an amazing job of bringing this to the masses. They were kind of the first. I would maybe disagree that they created yield. I think it was around probably before them, but they certainly drove a lot of the widespread adoption of it. One of the things, looking at just Celsius and others, I wouldn't sort of specifically call them out. Their model tends to be, give us your crypto, we'll lend it to institutions. Those institutions then go and invest it in DeFi. We're kind of saying, well, we'll just cut out that middleman, and that's why we pay 50% higher yields on stablecoins than some of our competitors in the kind of CeFi space. It's just removing another layer, and it's quite interesting because that tends to be their kind of what they preach about, is removing intermediaries, getting rid of the banks, that sort of thing. It's, well, your customers tend to be the big asset managers and the banks, and they're the ones who then get the bigger profits at the other end, and that's what we're passing on.
Phil, what can you tell us about how your background got you to where you are in crypto? You have a bunch of senior and VP level experience from the world of legacy finance. To what extent was that an asset getting into crypto, and to what extent was that a liability getting into crypto?
I think it's a really good question. I think I do like the term legacy finance. That's good. It's a good way, another good way of looking at it. I suppose the traditional finance. I think my background was long short equity and investing. So I was always very kind of market neutral. I wasn't a huge kind of didn't like being an outright risk taker. So I think that's what really attracted me to decentralized finance, that you have stable assets, or at least ways of risk managing assets in kind of in certain pools, which means you don't have the same volatility that you get if you just have like an outright bet on a specific coin. So I think having that kind of understanding of risk managing large pools of capital, that was a big asset. In terms of like just the where it didn't help me, I think, is around just looking at kind of the returns. So when I speak to a lot of, we aim to be a bridge between a lot of big traditional finance houses and kind of DeFi. So the first question I get from anyone is, it's too good to be true. It's got to be too good to be true. What's wrong with it? What are you doing? Because everyone is schooled to expect very, very low yields in kind of dollar backed assets. And I think that was getting my head around that, and sort of, it required me to, put a big chunk of my own net worth at risk in these protocols to really get my head around it and get comfortable with it. I think a lot of people in traditional finance have the same problem.
I got one more question for you, and then I want to throw it over to Jacob and Stephen. Regarding your book, The Money Triangle, what's one thing people could or should be doing with their money to protect it or maximize it that they aren't already doing in general? What's like the most common money mistake you see people making, whether it's crypto or fiat?
I mean, there's quite a few. I mean, the big one is just taking the right level of risk for kind of your time of life. And I know a lot of, I've got a caveat there with a lot of people aren't comfortable with any kind of risk. But if you're putting money away that you're investing money that you're not planning on touching for kind of 20, 30 years, you need to take a decent level of risk with that, because you're battling kind of inflation, and that's skyrocketing at the moment, as we've seen with all the money printing that's going on. 70% of the cash that's circulating now wasn't here a couple of years ago, and so if you're not earning 5, 6, 7% a year, the money that you have is sort of depreciating. So getting people to look at taking a bit of risk with their money, and in an adjusted way, and whatever they're comfortable with. We don't want people not being able to sleep at night because they're worrying about it. But it can be incredibly financially damaging if people aren't taking appropriate risk with the cash that they do have.
Jacob, Stephen, what questions do we have for the man?
Yeah, Phil, your company is actually taking advantage of a business model that I wrote about a couple months ago, which is centralized front end, decentralized back end. Because you are right that right now most people do not want to put 10K into a MetaMask browser extension and then trade that on Uniswap. And also most people don't know what liquidity provision is, what impermanent loss is. There's a lot of stuff that you would have to put into your own hands to take advantage of this yield. But what your company seems to do is make it be ridiculously simple to put your Bitcoin, Ethereum, or stablecoins onto your interface, and then you guys will handle all of the back end infrastructure.
That's exactly it. And it's I think increasingly what we're seeing, and we're having conversations with some other protocols that have been really successful, and you would see as kind of mainstay DeFi protocols, and saying, look, can we be the translating layer and bring a different type of customer to what historically was what now appears as slightly more complicated kind of structures within the DeFi world. I think that's a really interesting kind of proposition, because there's certain protocols that just exploded in popularity, but it's amazing when you then look at how many people actually own these tokens. It's kind of 5,000-10,000 like max. And you're like, God, this is actually tiny. It's kind of a small pool of very affluent crypto investors. And it's like, well, I'm passionate about getting everyday people. Some of these opportunities are so are amazing, and they're wealth creation events that we were never going to see very often. And it's like most people are missing that move. And it's like, so how do we kind of democratize it, which was very much the whole idea around sort of cryptocurrency in the first place, was allowing anyone in the world to be able to access this, borrow money, whatever it is. And I think that's something that I really hope we're able to kind of leverage in the next couple of years.
So are you planning on, because you are saying that you want to be able to get retail investors, everyday investors who may not know much about crypto, are you planning to add maybe an exchange or something that someone can just deposit $500 directly on your website and choose, oh, I want Bitcoin, Ethereum, and then you purchase it for them and then lend it out and give them the yield, rather than them having to buy the crypto separately and then add it to your site?
Yeah, I mean, this is something that I'm really proud of the team on. We're not that old. We kind of launched the app in kind of the early December, but from day one we built the web, the Android, and the iOS all in parallel, with a great team of devs who have just smashed it out of the park. But also we built, there's been companies in the space who are like now after 4 years saying like, we finally got an exchange function. It's like, well, we built that alongside all of that. So when someone can come, they can deposit normal currency onto the platform. They can then buy Bitcoin And it's, we expose the market maker pricing is the market maker pricing. We have several market makers that quote. We earn nothing out of that exchange. It's completely free. And then they're earning interest immediately, and it's paid instantly. It can be claimed daily, and it's completely flexible. So what I'm hoping with that model is when we look at the kind of traditional world of centralized exchanges where 95% of their revenue comes from people just buying and selling different cryptos. First of all, we know from traditional finance, people who do that lose money in the long term. They get greedy, they get fearful, they buy and sell at the wrong time. It's not how you make money in most conventional markets. So we're hoping that how we're going to change the landscape is it's like stop buying crypto at exchanges that don't pay you interest immediately and stop paying to exchange assets. So someone could come and say deposit whatever cash you've got or crypto if you want to convert it, put it into these assets and earn interest immediately. And just that, and we're looking for that kind of longer term investor as well, because we're not looking for people to jump in and out all the time. It doesn't mean we're not trying to encourage that behavior because we make no money out of it. And it's what we want is long-term holders who want to earn yield and hang on to their crypto for a long period of time.
Yeah, well, I really appreciate that you guys are giving the market maker prices, obviously, because that's how other exchanges make their money, is because they get a market maker price, they make it a little higher, and then they take that marginal difference. So you're just kind of being transparent and saying this is what we're being charged to give you these assets.
It's really interesting because you look at some of the most successful crypto companies, and they are exchanges. But then if you look at the world of kind of conventional finance, the biggest companies there are asset managers. It's not exchanges. They make money via sort of building assets under management and things like that. Obviously, we've seen some of the successful exchanges open, but on the whole, that's the business model that's won in the long term. So I think that's more what we would like to have, and I think it promotes the right kind of behavior as well. I mean, there is definitely a place for people to buy and sell and actively trade, and the platforms are designed. You see platforms that are designed for that. It's charts, it's bid offer spreads, it's all the usual stuff. You won't see that on our platform because we're sort of saying that these are longer term investments because personally, having spent my life investing, that's how I've made money. It's longer term investing, not every time I jump into something and I generally lose money. So it's sort of like longer term sort of like patient investing is where I've always done better.
Yeah, time in the market versus timing the market, as some Warren guy said a long time ago.
Yeah.
Exactly.
So
where are we at, guys? Is it time? Oh, you got a question?
Yeah, I got one more. So correct me if I'm wrong. There's no like lockup period. Once you put in your funds, you can immediately take it out.
Yeah, and that includes the interest. So that was something that it was a bit of a technical challenge to overcome, but I loved the feature, and we had to keep it. So the moment the funds are on, you have a little earnings ticker that ticks up in real time, and then you can take the funds out. The only thing we have a slight thing is you can take the funds out you can take them out every day. It's not an instant withdrawal like you'd get through some exchanges. And that is predominantly a security feature. When you've seen exchanges get hacked in the past, it generally is 200 billions out the door in 30 seconds. So we have this sort of time lock where you can get the assets every day. There's no longer lock in than that. But we've got a team of analysts that are analyzing all withdrawals, so make sure manually checking them to ensure that nothing is obviously wrong. And we've built systems around looking for anomalies in that. So that was quite a key feature. It's a little, so the lock-in is sort of daily. You can get the money out daily, so you don't have that instant liquidity. But I'm hoping that customers appreciate that what they're losing in that instant, they're gaining in kind of security.
Awesome.
Well, right on. If you've watched this video this far, you might as well like and subscribe. Be sure to check out Phil and his company. You can learn more about AQRU at AQRU.io. This podcast has been brought to you by TokenMetrics.com. I want to thank our panel, Stephen and Jacob, and our guest, Phil, for joining us on today, Wednesday, January 26th. Thanks, guys.